What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is April 26th of 2023. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, we've got to talk about the first major sell-side signals in equity markets that are not only going to have an effect on the broader stock market, but more importantly, how it's going to have rippling effects on both Bitcoin and cryptocurrencies as a whole, as people start to take a more risk-off narrative. We've got a whole range of things to talk about in today's video, from earnings reports to price action analysis. So if you guys happen to enjoy my rambling, consider dropping a like. It's one of the best ways you guys can support the channel. And we've also got a sponsored review later on from one of our long-term partners here on the channel, Radix DLT, one of our favorite L1 plays over the next coming years. So stay tuned for it. You guys won't want to miss it. Okay, so let's go ahead and kick things off here. And I want to start here by talking a little bit about what we discussed on Monday's video and continue to follow through. As you all may recall, we have been talking for the past couple weeks about how we're finally starting to act on our bearish narrative. We're looking to start building those short positions. We're in the price range where it's looking like it's time to start striking. And one of the big things we discussed yesterday, an important nuance here is to not get too eager. So again, back on Monday, if you guys want to go check out the video, I definitely recommend you guys go watch that before this one. But essentially speaking, we talked about the idea that even though Bitcoin has corrected here from around 31K, do not be surprised by secondary shocks to the upside, where we could come back up to these kind of previous resistance ranges like 29K, or even back up towards the relative highs at around 31K here in the near term before we really start to make a move down. This is a really big dilemma that a lot of traders come into, because even if you are on the right side of the trade here, if you're right that over the next couple of weeks or months, there's going to be some major move to the downside, and you're starting to position yourself in a position that would benefit, i.e. a short during that period of time, one of the biggest problems is that people either set too tight of stops or they start using too much leverage. And that can leave them in a position where if price swings up 10% in the opposite direction of what they're looking to do, well, that can leave you getting knocked out of your position. Again, I want to just put this in perspective here. If you'd built a short here back on Monday and you're using, say, 10x leverage, you're going to get knocked out if price moves up this high. And that's why, again, we are not promoting that you go out and use extremely high levels of leverage, let alone we're not promoting any affiliate links to leverage or derivatives trading exchanges. I'm not a fan of promoting that here on YouTube, and I'm not going to be pushing that on you. Doing a 2x leverage at max or buying puts or shorts on crypto equities, that's another way you can approach this. So again, don't feel like you need to go all out crazy trying to time the market and betting so aggressively to a degree where your risk is going to potentially knock you out of your positions. And again, we always have to assess, perhaps as we're starting to act on our trades, while we have our opinion here on the channel, we've got to be smart about having a solid exit strategy in case things go south, if things don't go our way. So again, if you guys want to get access to all those steps and what we're going to be doing in order to protect and hedge yourself, you guys can check out the Dash Report. It's our newsletter here on the channel. But I want to let you guys know generally when we're really starting to initiate some of those bets to the downside. But again, we're waiting here for Bitcoin to come up, retest some of these ranges, chop around a little bit. That's the whole idea of relief rallies and generally these kind of traps in price. We come up into particular ranges, we chop around, getting a lot of people excited about a potential further breakout. The FOMO is still real as we're hanging up in this range around $28,000, and then eventually we roll over once it's time to start fading the trade. Another thing I want to talk about here, again, same thing here with total crypto market cap. We are in the channel where we've expected resistance for some time. I'll go ahead, zoom out here so you guys can see what we're talking about. We discussed it the other day, that huge weekly reversal candle here, 9.2% to the downside, as you guys can see in the top label. And versus the 8% move we saw previously. That's a bearish engulfing candle and is likely the sign we're going to start to break out of this channel relatively soon to the downside. I think altcoins are going to give the first sign of weakness. We're going to go back to people pulling on strings saying, oh, but Bitcoin's holding up. You know, isn't this a sign that Bitcoin's just going to be this digital store of value? It's going to be a hedge. If you guys haven't seen for the past couple of weeks and months, Bitcoin really isn't doing that. It's not playing into that narrative. It's been sitting sideways. This is not a bank run on mass scale as everyone has been selling the bulls on for the past couple of months. It's not that we don't like Bitcoin here, guys, or crypto. I just have to call out BS narratives when I see it. The metrics don't show it. stablecoin liquidity does not show it, and price action just doesn't show it here. So that narrative is slowly but steadily starting to falter. People are kind of drying up on their FOMO here as we hang up in this range. Market makers are taking advantage of that period of time where prices are suspended to slowly distribute positions and sell their existing positions from when they probably bought them or were already holding them for a long period of time, now at a much higher price. And we're going to start to see the follow through here over the next couple months. And I want to spend some time to talk about why we believe that. Take a look here at what happened, excuse me, what happened here in equity markets yesterday. We had one of the worst trading days here for the vast majority of indices since as far back as a month ago, back in late March. Last time we saw this kind of move in the Dow Jones of over a percentage point was back here on March 22nd. And it came at, couldn't have come at probably a worse time here as we retested back up towards the previous relative declining resistance range, setting in a third relative lower high in this period of time since back at the start of the year or around late December. Now again, these defensive stocks should be able to produce higher lows and higher highs and continue climbing higher. They are cash-rich companies. Many of them are still even technology plays here. A lot of the companies that, again, are defensive players who have large amounts of dividends that they're paying, strong cash flow. They can hedge their existing goods and services with higher prices, to tackle the worries of inflation, which is what the markets are really worried about at the end of the day. And still, the Dow Jones is continuing to set in a lower high since as far back here as mid-December. And it is not showing any sign of really starting to kick off another bull market, but rather looks like it's ready to come down and retest some of these ranges to see whether or not bulls can actually come in and provide support. That's a 10% move here for the Dow Jones if we come down to this range. But if we come back down to the previous lows, you're talking about a massive move to the downside. If we see that and potentially moving down to new lows, we're talking about a 15 to 20% move in the Dow Jones to the downside. That's not going to help you even if you're getting paid some kind of dividend from these stocks. You are going to be brutally hit by buying at these prices if we start to go down to that range. Now, I'm not speaking in absolute terms. I'm just trying to make it very clear. Some people say, oh, well, I got to put my money somewhere. I've got to be able to hedge against inflation. And these stocks are paying a good dividend, some kind of good yield that I can rely on. The problem is, if you're buying up at this range and you face a major principal loss, your dividend isn't going to save you, right? If you lose 15, 20%, if the Dow Jones on average is paying 1.5% or maybe 2% dividends, you're looking at 10 to 20 years to make up for that loss. Of course, maybe the equities will rebound in good time, but why not just buy them when they're at a cheaper rate? And you're going to be earning a higher dividend percentage likely from that range. Do not get suckered into the trap of dividends. Big mess up that a lot of people make when it comes to equities. Another thing as well, the S&P 500 here, double top at the similar range we saw back in February. Not a good look here for equities. The worst trading day we've had since as far back here as late March, down 1.5%. Now, as you can see again, we've had this kind of ascending triangle that we spoke about back in March. When we snapped through here and we faced resistance at this range and have not been able to get above there, that's your first sign of weakness here, guys. If we were really stepping into a bull market, if we were really seeing price sustaining towards a level where we could really start to move up in the long term, we should be holding these kind of technical patterns, breaking out higher. The FOMO should be real because it's still at a relatively large discount from where the previous all-time highs were. Unfortunately for the bulls, we are not seeing that here. We are continuing to see staggering weakness. Essentially, if we just viewed on the monthly time frame, it becomes abundantly clear here that we've been facing resistance at around 4,000 to 4,200 points on the S&P 500. It is a continuous range of chop and sideways pressure. And this is why, again, looking at the weekly time frames, looking at the monthly time frames, and utilizing some of our really powerful momentum indicators and different indicators that we use here on the channel, they can help on the monthly and weekly time frames to really signal, cut out all the noise, and make it clear that, like, hey, this is not a trend. This is chop. And that's not good to see for nearly a year now. It has been almost a year of chop here for the S&P 500. That does not signal confidence to me for a bull market. And sure, you could say, oh, well, since October, we've been moving up higher here. We're up 500 points. But that's exactly the same case, basically, of what we had here in June. And back in July, we recovered that in a single month. Instead, we had the longer recovery here between October and November and have just been chopping sideways. I just got to tell you guys here, again, I want to zoom out here and I want you guys to answer this for yourselves. I'm going to turn on my drawings here, right? And just focus here on the price. Does this look like a typical, 20, 30% buy the dip opportunity from the last decade, where the central bank can just come to the rescue every time? Or does it look like the beginning, right? The relief or disbelief stage before a broader bear market? I'm not saying it has to be as brutal as the dot-com bubble or the '08 recession, where we had the housing market, a lot of issues within the banking sector. But don't you think we're at a minimum going to be revisiting towards these lows and potentially going to new lows, likely somewhere in this range here around 3,000 points? Isn't it high time to start worrying about what we can afford to lose, not what we can afford to make? I gotta tell you guys, this chart to me does not signal confidence. You guys have seen in previous videos, we've shown our monthly momentum indicator here. It is not signaling a blue flip, meaning that we have not seen a trend reversal or any key sign that we are likely to reverse trend. If anything, we are likely to continue moving lower. Last but not least here, we got to talk about the NASDAQ. NASDAQ bleeded worse than anyone yesterday. It might pop up a little bit here in pre-market due to some of the earnings reports, which we're going to talk about here in today's video, but this was one of the worst trading days we've seen in some time. If we go all the way back here, I think even further back here towards March 9th. So about a 2% move to the downside, taking us back to where we were really for the most part over the past months, since as far back as February, signaling the sign that technology stocks are not really ready to go on another full swing bull market. A lot of people are buying the FANG stocks, they're buying large names like Microsoft or Apple, just thinking that, hey, buy the dip. We've always done that. It's always paid off. And sure, over the last more than a decade, during the last secular bull run, that was the name of the game. Just buy the market leaders at a 20 to 30% dip. But we are not in a secular bull market. That's the narrative I really want to drive home to you guys here, because the Federal Reserve cannot just come in and step in and save financial markets. But it's not even that the Fed can't come in and save financial markets, because they have to deal with inflation right now. And they're going to have to continue dealing with it for, at a minimum, likely 6 to 12 months. That's the best case scenario here for these inflation waves. They take a long time to deal with. That's not even the concern though. The concern here, and this is a very important point I want to drive home, is that technology stocks, growth stocks, only do well when there are real growth expectations in the future that are consistently delivered on, right? And consistently beaten on, okay? So I want to really try to kind of explain this in the best terms possible, right? The narrative here for a lot of these technology companies and a lot of the value of the NASDAQ comes from the idea that Amazon, Meta, any name you can think of, Netflix, Google, all these big tech giants, right, that have been rallying and leading the market over the last decade, that they are going to continue climbing higher because they're laying off employees. They're cutting costs where they can in order to maintain some sense of profit margins or be able to mitigate against slowing growth. And that's just somehow going to justify equities continuing to move higher. Now, on the surface, if we think about it, it may make logical sense, or it may sound like it makes logical sense. But one of the big problems that people don't understand is that equities move up in valuations. They continue to start new bull markets and really kick off and lead against the broader stock market, providing exponential returns only when there are growth expectations. And this is the big dilemma that people run into, guys. We need to ask ourselves here, right? And once we zoom out, we come out to the monthly time frame, this becomes abundantly clear. Right now, we are in the quote-unquote kind of accumulation range, where usually in the last secular bull run, we should be seeing equities only hang in here for a little while, as we usually see, just for about a month or two, and usually we leapfrog up here for the most part, right? And we start to kick off even further most to the upside, right? That's what the bulls are betting on right now. But we need to ask ourselves something very important here. Going back since here in 2020 and 2021, or really just during this period of time, technology companies quarter by quarter, year by year, saw solid growth and showed continued projections that they were going to continue growing in their respective sectors. Now I want you to think about some of those names we talked about earlier. Amazon. Is Amazon, through its cloud-based services or through its actual retail consumer business online, are we seeing exponential growth? Well, actually what we're seeing is relatively stagnant growth in these companies. It kind of makes sense. We had the best scenario for Amazon during the lockdowns in 2020. How can a company like Amazon do any better? since 2020. They had everyone having to order online. Amazon, stalling as a company. Its cloud-based services, not seeing significant growth. Meta, right? Meta itself is made up of Facebook, Instagram, WhatsApp, social networks that have been relatively stagnant in their growth. They've reached the late stage of their business cycle as a company. What's Facebook going to do or Meta going to do to continue growing? Well, they're betting on the metaverse. That's their big bet in VR and AR, virtual reality and augmented reality. I think you all know that as much as there may be some potential there, it's 5-10 years away, and a lot of people aren't picking up on that trend. But I know the big narrative that everyone is really excited about, and that's AI. You guys, if you watch the channel enough, you guys know, and we're going to talk about this here as we go into the topic of Microsoft, that this is a bunch of hoopla here in the short term. I've used AI systems, I've used ChatGPT. I know that it is definitely going to be powerful. I'm keeping up to date with like all the nuanced parts of the AI trends from AutoGPT and all these really exciting kind of spin-offs where they're finding really interesting ways to kind of make AI agents and stuff. But I gotta be honest with you guys, if you have toyed around with these systems, while they're definitely a very exciting novelty and sometimes can be used for very niche specific applications, this is not a technology, at least at its state, that is going to save a multi-trillion-dollar tech giant like Microsoft at its current valuations. And we gotta talk about this here, guys, because this is a big misconception that people have, right? So Microsoft did beat on earnings last night. I think this is the same with Alphabet and a lot of companies who would revise their earnings relatively low. Very important point to understand here, guys. Just because a company beats earnings or misses on earnings doesn't mean that the stock price is going to move in either direction. I.e., if they beat on earnings, the stock price is going to go up, or if they lose on earnings, it's going to go down. That's not true. That's a big misconception that people could have here with financial reporting. It's just simply that they beat expected earnings report, quarterly estimates or annual estimates from the actual companies themselves or external different types of analysts or providers in the financial system. Now, I want to go ahead and focus on really an important detail here. While people definitely looked at the numbers for the earnings per share being around 2.45 versus 2.23, definitely still really solid financial report. I'm not going to lie about that. 52.8 billion versus the 51 billion estimated by analysts for this quarter. There's a very important point here that I want to focus on, right? I like Satya as a CEO. Microsoft has built a titan of enterprise companies like Azure, its cloud business, Office 365, all types of different things around cloud-based services that have really been the bread and butter for Microsoft here. And that's really where we want to watch whether or not Microsoft is going to be able to sustain in a bull market if it's still seeing really accelerated growth. And I got to be honest with you guys, still, quarterly growth on its cloud services, still pretty impressive. Definitely wouldn't have expected these kind of numbers. But as you can see, cloud-based service growth, right? 50% growth back just a couple quarters ago, much better than 27%, right? And as that number starts to creep slower and slower and slower, but steadily towards that 0% target, towards 5% growth quarter over quarter, people start to ask a really big question. Why am I paying the premium on Microsoft that I am? As an institutional investor, I see Microsoft is trading at a 25-30 per point PE multiple, right? 20-30 times annualized earnings, but growth is slowing. That doesn't really give me a good 5-year time horizon for the multi-million-dollar position that I want to build in Microsoft. So we've got to start looking for growth opportunities elsewhere. Where's the growth going to come from? How is Microsoft going to go from a $2 trillion company, $2.5 trillion company, towards a $5 trillion company over the next 5 years? I want to find a way where I can make a 20% return year by year. I want to outpace the market. Why would I be betting on Microsoft versus just buying the S&P 500 or keeping in cash and going into bonds and getting some kind of yield? Well, notice here how on this entire chart, while we've been hearing a ton of AI talk, in fact, if we go over here to the Reuters article, a really good point I picked up on here is that it didn't take Satya, in this case as CEO, more than only 5 words to mention AI in his comments during the quarterly earnings report. Look at this chart here and tell me if you see anything that talks about AI, right? Sure, the Office 365 commercial systems, PowerPoint, and Word might use some of ChatGPT or OpenAI's technology or some things like that. But just take a look at this chart. Do you see any mention of OpenAI revenue or AI services? I don't see any mention of that. In fact, they did not mention the revenue potential here specifically from OpenAI's technology as one of its own separate categories. Now, you would think that with all the hype around AI, with all of the adoption, there's definitely been a massive amount of users using these systems. We are not seeing that within the quarterly reports here. This is a big dilemma that a lot of investors struggle with, guys. I don't want to speak from a monolith of opinion, but I'm going to give you guys my opinion straight here. There's a lot of people who will tell you, you got to buy NVIDIA, you got to buy Microsoft, you got to get long on crypto and every single speculative asset because it's the time to buy. AI's here and it's just going to be this exponential technology that just completely changes our world. And it's going to make Microsoft, which has a pretty large extent of exposure, upwards of 40-50% to OpenAI and therefore ChatGPT and its technologies. People are of the narrative that this is just going to transform our world within 3 months' time. ChatGPT's been around for a good couple months now. And while it's a really fascinating business, it burns through a lot of money. And on top of that, it's not generating the kind of revenue people think it is. With a couple million people paying $20 a month, it may sound really great, but that's not the kind of cash cow that even puts a serious dent in Microsoft's business. Even OpenAI as an entity at its current valuation is a fraction of the $2.5 trillion market cap of Microsoft. That is a reality we need to keep in mind here when we see these kind of relief rallies. Microsoft has rallied a significant amount here over the past few weeks. It's well deviated above its 200-day. And the question is, can it continue to climb here? Can it continue to expand in its valuation beyond the point of $2 trillion here? I just don't think that's going to happen. I don't think that AI as a narrative is just going to save Microsoft as a company. Not to mention when it's got other competitors, it's got Google, it's got Amazon, a lot of other people sinking their teeth into this industry. I think it's something that's going to take a couple years. I think AI could very well be a narrative in the next bull market. It could be what helps us to buck the trend and see Microsoft, these companies really continue to be market leaders after a correction, after valuations get discounted. But I don't see it happening right now. And what we saw here over the past couple of days proves that we're likely getting to a point right when everyone is feeling the FOMO, right? Volatility was at one of its lowest levels since January of 2022. We get an immediate surge back, short-term deviation. This is the time where I'm looking to short optimism. I'm looking to short equities. I'm looking to short crypto. It's nothing personal, but nothing ventured, nothing gained here essentially. We want to start building positions when we have the confidence, when we have the setup, and when we see the initial signs of a trend shift. Because once we see those initial signs and we can start to place really solid risk-reward bets, there's some opportunities to make some serious money off of short-term optimism. And we are trading with the broader long-term downtrend, which is much more favorable for us than trying to trade relief rallies and go against the broader long-term trend. There are lots of ways to play this, guys. And even if you're not someone who wants to trade like this, you guys don't have to. If anything, you sit in cash, you wait for a better dip buying opportunity, you wait for that real capitulation low, and you get in at some really solid generational discounts for the next secular bull run. But I think that could be a lot further away than most people think. And that's why I always come here 3 times a week, guys, to ramble to you guys, share my thoughts on things. I'm not here to try to be deceiving or overtly bearish, guys. I'm here to be as realistic as I possibly can be, because there are plentiful amounts of people out there who are telling you to take overt risk in this market, who are still trading with the decade-long mindset of the secular bull run that we were previously in. We are no longer in that secular bull run, guys. And it's time for us to start facing that reality, considering the stickiness of inflation, considering the fact that FOMC meeting by FOMC meeting, the Fed is continuing to still have to raise by 25 basis points. 25 basis points. It's not pivoting. It's not lowering rates, even with everything that went on in banking collapse back just really over about a little over a month ago. We don't hear any more talk about the Fed coming in to save the day. And they're starting to reduce their balance sheet. They're keeping interest rates suspended. These are not the kind of things that are going to support technology companies. So anyways, With that being said, everyone, I hope you guys enjoyed the core part of this video, and let's go ahead and dive into one of the few exciting projects that we're really keeping our eye on here for the next crypto bull run, and one that we believe could really disrupt the layer 1 space when it comes to smart contracts, DeFi, and the broader crypto space as a whole. Alrighty, everyone, so in today's sponsor review, we're going to be diving into one of our long-term partners here on the DataDash channel, and one of my favorite L1s going into the next bull market over the next coming years, and that is no other than Radix DLT. Now, many of you are likely familiar with Radix, but for those of you who are happening to hear about them for the first time, Radix DLT is aiming to radically rethink the way we approach DeFi or decentralized finance. They're doing so by building from the ground up an entirely new layer 1 network that's not only highly scalable in order to service the kind of transaction load we need to get DeFi towards that $1 trillion plus market share, but on top of that as well, it's offering Scripto, its native programming language built around the Rust framework, allowing for developers to build extremely simplified smart contract code, and most importantly, not have to worry about the kind of security attack vulnerabilities that could potentially happen in traditional Solidity-based smart contracts on the Ethereum network. Without getting too technical, developer scalability and network scalability offer Radix the opportunity to allow for applications we just haven't seen within the crypto space to be built, and for existing ones to be built at lightning speed with much higher degrees of security. And these alone offer a huge amount of potential for the crypto space in order to get that next leg up. Some of you may recall from our video that we did yesterday, we talked a lot about how DeFi has kind of stalled as an industry. And there's a clear reason for this. It's not that the DeFi industry just completely shut down overnight and people stopped building. There are clear problems, not just security vulnerabilities, but limitations that come with building smart contracts in Solidity. And we need to understand just how big of a deal it is that we now have a network that's looking to fix this, that not only offers all the same capabilities and functionalities of the Ethereum network, but also offers a framework to build entirely new applications. So before we dive into some of these really exciting updates, I definitely recommend you guys take the time after this video, if you seem to be piqued in your interest, definitely go check out the white papers for the technical documentation around Radix as a network, around Cerberus, the consensus mechanism, around Scripto. If you are a developer yourself or looking to become a developer, I highly recommend you guys read into some of the documentation around Scripto. There's a really great category or section of the website that's dedicated specifically for developers, and Radix is constantly doing grant programs and giveaways to people who are building within the ecosystem. We're actually going to talk about that a little bit later on in some of the really exciting developments they had as recent. Now, if you guys are just looking at this from an investment perspective, I'm not going to tell you guys here that you have to go out and buy anything and stuff. At the end of the day, I want you guys to make that decision, seeing as they're a sponsor here on the channel. But I got to tell you guys, Radix is one of the few projects that I'm genuinely interested in. We have a couple projects like Radix or Clixivia that actually pique my interest here going in the next bull market, that actually have built substantial products. And the market has gotten really excited as we're approaching the next major network upgrade. It's going to be sometime in July. So we've got a lot of optimism coming in here, a lot of volume peaking as well, and there's a good amount of exchanges if you guys are interested to check out Radix, from names like KuCoin, Bitfinex, and a whole list of other exchanges. You also can buy EXRD on Uniswap, so it's really open up to anyone. It's a tokenized version backed one-to-one with XRD tokens, as it is a native protocol token. But just want to let you guys know there are those different avenues to get exposure to Radix. And it's a relatively small project when it comes to valuation versus the other ones like Cardano and many other networks who really haven't done much more, if anything, better than what Radix has done, at least in my opinion personally. So let's go ahead, let's talk about it here and discuss some of the major developments. If we go through the news and insights section of the Radix team, this is their blog section where you can get access to some really interesting developments. One of the big ones is the partnership or integration they recently launched with Layer 0, integrating in the Radix network. Now this is very important because if you guys may recall back a couple videos ago, we talked about a project called Reunit, which is actually utilizing omnichain technology, or Layer 0's technology of omnichain support, allowing for people to seamlessly move assets or do cross-chain transactions within a singular transaction. And this is a really big deal here for interoperability, and more importantly, Radix continuing to be tapped into the broader range of liquidity from other networks. This can allow for people to essentially have liquidity on the Ethereum network and be able to take advantage of an opportunity on the Radix network network in a single transaction. And vice versa, if I had liquidity on the Radix network, it allows me to tap into a whole range of other well-developed layer 1 ecosystems or layer 2 ecosystems in a singular transaction. And this is a really big step forward. Layer 0, for those who may not know, is becoming a really big name in the crypto space. They have essentially led this trend of the omni-chain future, where essentially you don't need to worry where your liquidity is, or have to worry about bridging liquidity and then conducting a secondary or third wave of transactions. Instead, being able to conduct them all from one. Now again, at the end of the day, for Radix, it's important to first focus on building its core layer 1 ecosystem, bringing in liquidity, and definitely building its own applications as an ecosystem. But having this tap into layer 0 is going to allow for some really exciting things to happen, and it's going to allow for the acceleration of adoption of the Radix network. This is a net win-win for both parties here, but especially for the Radix network here, as it's going to allow for liquidity and activity to start tapping in towards its ecosystem and taking advantage of opportunities in the market, being able to engage in DeFi protocols, and further grow TVL and adoption of the network. Next off as well, I wanted to spend some time to dive through as I was kind of reading through some of these really exciting projects that came through out of the recent Scripto DevPost DeFi challenge. So this was a recent challenge that they put out where they actually had some XRD monetary rewards for different protocols or projects being built within the Radix ecosystem. But I think there's some really exciting stuff that came out of this. Now, it's important to mind here a very important fact. Scripto itself as a language was slowly revealed to the world over the past year. I remember when Scripto first was announced and that they were slowly starting to release some of the libraries around it in GitHub. And since the past few months where people have really been able to test Scripto in the wild, have been able to actually build applications rather than just thinking of theoretical concepts and trying to understand maybe where the language would be applied. And we've actually been able to see people building applications now within this build up towards the official mainnet launch, where there'll be full smart contract capabilities, taking it live to the main network, and really bringing the Radix network to life essentially. Since then, though, we've been able to see during this $1 billion dApp Scripto competition some really exciting applications being built. I'll just go ahead and run through some of them here very quickly. The biggest winner here was Flashify, which, as you guys may be familiar with if you know about the DeFi ecosystem, a big part of DeFi is Flash loans. And essentially making sure that Flash loans operate in a sound way, essentially allowing you to borrow liquidity for a single transaction and then returning it within that very same transaction, right? This relies on composability, being able to actually go in and conduct these transactions all from one step, returning liquidity, and simply just taking advantage of some kind of opportunity in the market with that borrowed liquidity and returning it back immediately. That's the principle of a flash loan. And the idea is that it should be very simple, streamlined, and allow you to essentially use it for one particular transaction, returning the liquidity after, taking advantage of some kind of arbitrage opportunity within the market. And we can see here that Flashify essentially does that. It allows you to borrow something like XRD here for a fixed period of time. You pay some kind of fee in the transaction, and then the liquidity is returned back after you've taken advantage of some kind of arbitrage opportunity in the market or have taken advantage of some kind of DeFi activity. This is really essential in order to bolster liquidity, be able to get prices stabilized on AMMs, and all types of different things within the DeFi ecosystem. So it's interesting to see some of these more kind of original products within the crypto space being built, some of the foundational tools that are going to be needed in order to build a core DeFi ecosystem and bolster liquidity. But there's also as well StoicFi. So this was another one as well. This was the runner up here, which built more of a broader range DeFi ecosystem. So essentially, they not only built a DAO with SUSD or kind of synthetic USD. This is essentially similar to DAI and MakerDAO in the traditional Ethereum ecosystem. So offering that kind of core crypto-backed stablecoin within the crypto space that's fully decentralized and censorship resistant. Definitely something that we're going to need to see within the Radix ecosystem for it to thrive long term. But they even took it a step further. They also have a built-in automated market maker, which is going to allow for swaps between assets within one single interface and one single ecosystem within the Radix ecosystem as a whole. And this is where I think, again, it just proves how easy it is to build within Radix. We are already seeing people building within an entirely new language framework, applications like Uniswap, similar to that of MakerDAO, all in one core application within a matter of just a few months. This is massive stuff, guys. It's not as simple as someone, for example, like SushiSwap copying the Uniswap code and deploying it under a new logo and brand, or making some slight modifications or improvements. Now, this is building in an entirely new language framework. And if the fundamental applications of DeFi are being built this quick in a bear market, I'm really keen to see just what else people are going to be building. Once we have stablecoin liquidity, once we have on-ramps within the ecosystem, once we start getting some of these fundamental tools being built out, what is it going to look like, and what are people going to be able to build on top of that within Scripto as a language? So just for context here, to kind of get some perspective, Uniswap v2, which was kind of the core version of Uniswap that really accelerated it as a brand and really built out the DeFi ecosystem as a whole and the liquidity needed for tokens to thrive. Uniswap v2 is an application, and I think Uniswap v3 is even bigger. It takes thousands upon thousands of lines of code. And it's not only about the time to develop that code, which obviously does take time and resources to build, but it's worrying about the security vulnerabilities. If one line or a certain paragraph or section of that code is vulnerable, or there's a potential attack vector, that could ruin an entire protocol, like an automated market maker like Uniswap. And that protocol, that same variable protocol, can be built with just a few hundred lines of code, sometimes as little as 150 to 200 lines of code, versus the thousands upon thousands of lines of code. And there's a lot less security and attack vulnerabilities on Scripto as a language, as of the way that it's built, being an asset-oriented language versus Ethereum and Solidity, which again is built in a very unfortunate framework that allows for a lot of security and attack vulnerabilities as a programming language. So again, I don't want to ramble on too much here or give too much praise to any particular project. These were the ones that won first and second place, and there's a lot of other follow-up projects as well. There's also Skrilla Lending as well, which focuses on lending within the overall DeFi ecosystem of Radix, and a couple other ones as well that you guys can read into within the article, as well as some other honorable mentions. But I want to go ahead and continue to talk a little bit about some of the other developments here, some of the major network upgrades. One of the big things that a lot of people have pointed to recently is one of the major network proposals that was proposed on the Ethereum network, a new ERC standard, ERC 4337, around account abstraction. Now, I want to go ahead and talk about this here because I have a little bit of personal experience with this within the Ethereum ecosystem. I had my own crypto wallet, and we kind of focused on this technology of account abstraction, or smart wallets, as it was commonly referred to as back in 2018, 2019. Essentially speaking, this technology focuses on the idea where you don't need a seed phrase to manage an account. A big pillar of Radix as an ecosystem is that it's focused on removing this need to have seed phrase. You can still have a traditional seed phrase. It's the 12, 24 words that essentially give you access to your funds or effectively work as kind of a pseudo-private key. But while a seed phrase does work and it's highly secure, one of the big problems is it's a really big friction point to the user experience. Radix has actually been working on making it so that seed phrases are an option, not a mandated statement. Essentially, you're able to utilize account abstraction by utilizing your multi-factor device like your phone or some other type of thing like YubiKey or something that essentially will allow you to have a much simpler login process. And you can also have guardians as well. This all again comes back to this technology that has been around for some time in the Ethereum network, and now there's this proposal to ideally, supposedly, bring it to the mainstream within the Ethereum ecosystem. That's why it's ERC. It's again focused around the Ethereum token standard and allowing for this to happen within the Ethereum ecosystem. The big problem though is that this still requires an incredible amount of work on the part of developers in order to implement, but on top of that as well, it simply offers a ton of additional potential attack vectors to the Ethereum network. This is the big problem here with a lot of these Ethereum proposals or different types of ERC standards. As you stack on these technologies onto a legacy framework that already has a lot of issues as is, it's going to add more complexity, not just for the developers in implementing it, but potential attack vectors and issues when implementing these new changes. Whereas within the Radix ecosystem, it's built natively into the protocol. So I recommend you guys read into the article here, check it out, read a little bit into why it potentially falls short here. This isn't meant to be too much of a harsh criticism here. It's just the Radix ecosystem and the developer team focusing on the points here that, essentially speaking, having it built in natively into the protocol as a standard is much better than having some kind of ERC implementation in the Ethereum network. Plain and simple, all right? Now, there's a couple of big things that I want to close off here, guys, and that is the Babylon upgrade date. So there has been a slight pushback here in the launch of Babylon going from June to July. So this is where, again, as we've discussed, full implementation of Avalon is going to be coming live to the Radix network, and this is going to be a major change up here. It is really going to allow us to see all the hard work that the team has been working on for the past couple months really coming to life within the Radix ecosystem. Multiple years of development that have gone on towards bringing us to this point is going to allow for the ecosystem to actually thrive, liquidity to start really coming into play, and really start to see some of the incredible things that people have been building behind the scenes for the Radix ecosystem. Now, I think that this is a good thing. I'd much rather wait an additional month here for the network to come up with these upgrades because, and I think as we can see within the market here, people are genuinely excited about that long-term vision. There seems to be a lot of FOMO here as we are stepping towards this network upgrade, and we're going to finally start to realize what value can be built within this crypto ecosystem or generally within Radix with crypto. So I think this is definitely going to be a really exciting thing overall. Again, if you guys want to read into the article, dive into some of those resources, definitely recommend you guys dive into it so you can be prepared. And if you guys are interested in getting to meet with the Radix team, no better time than today, because at Consensus in 2023, there is going to be a Radix booth. I unfortunately will not be able to make it to Radix, guys. I'm not able to travel at the moment here over this next few months, but I definitely think Consensus is going to be a really exciting conference. So if you guys are able to make it out there, definitely head over to the Radix booth. Talk to not only the team, some of the core team, but there's going to be a ton of different Radix-based projects that are going to be there as well. So you can get to chat with them, learn about their experience developing within the ecosystem, and learn more about what they're building. But overall, guys, that's it for the major updates here I wanted to share with Radix. I think there are a lot of exciting developments going on. It is still my #1 layer 1 play going into the next bull market. Hands down, there's nothing close to it. We have a lot of other networks that we keep an eye on here on the channel, and as much as some of them are building great things, I gotta be honest with you guys, you come here for my opinion, Radix is really the most exciting one for me, and I'm really blessed to have them as a long-term partner here on the channel. We're very particular about the companies and projects we work with. We turn away 98-99% of opportunities here. It's not just because they're a sponsor. They, to us, are one of the best layer 1 protocols from a fundamental basis. So that being said, everyone, thank you all so much for watching. If you happen to enjoy this video, if you made it this far and tolerated my rambling, consider dropping a like. It's one of the best ways you guys can support the channel. Definitely check out the link down below in the description. Do some due diligence in the Radix ecosystem. Join the Telegram, join the Discord. And until the next video, everyone, I'll see you all in the next one. Take care, everyone.